AI is often perceived as a frictionless software revolution living in the cloud, but behind the code, the ultimate bottleneck is heavy industrial machinery. For over a century, electric utilities had one job. They built predictable infrastructure, maintained grid reliability, and collected guaranteed returns approved by regulators, a model built on stability. The AI boom challenges that stability. To train and run the next generation of language models, a single hyperscale data center campus requires electricity on the scale of a small city. Historically, grid demand grew in predictable increments. Look at the steady, low-slope growth line driven by normal population trends, then compare it to the sudden vertical spike required by a single AI facility. Headlines focus on specialized chips and coding models, but the financial reality of the AI boom is about who funds the power plants and carries the massive grid demand risk. Because the true constraint of this technology has shifted away from software engineering and directly onto the power grid, boring utility companies are pulled into speculative, high-risk roles. To meet this massive demand, power providers are moving away from the safety of regulated models. They are building contracted power platforms, taking on higher execution risks for the chance at higher financial rewards. Consider the capital being deployed by National Grid Ventures. They recently committed $1.75 billion for a 35% stake in Joulent, an energy platform specifically targeting data centers. Joulent's first major asset is Project Kilby, located in West Texas. It's a 2.67 gigawatt gas-fired power facility designed to feed a data center operated by Microsoft. Building out gigawatts of new power requires heavy industrial supply chains. This project involves major energy players like Chevron and relies on massive turbines manufactured by GE Vernova to physically generate the electricity. The financial bridge holding this together is a 20-year power purchase agreement. This contract directly links the physical output of the utility to the computing demand of the tech giant. By swapping millions of everyday consumers for a single hyperscale client, the utility shifts its risk profile to resemble a venture capital deal. This sets up a core friction for the industry, a timing mismatch between the urgent speed of software development and the slow reality of pouring concrete for power plants. This charts Project Kilby's cash flow. A final investment decision in late 2026 triggers a multi-billion-dollar commitment. Construction delays first power delivery until 2028, and the project won't be free cash flow positive until the early 2030s. Capital providers must commit billions of dollars today, years before the true long-term utilization curve of these data centers is ever fully proven. Software can scale with high incremental margins, but physical infrastructure cannot. AI requires land, water, transmission lines, and fuel supply. Historically, electricity demand was predictable. AI power demand is different. It's highly volatile, driven by a handful of tech companies racing to train competing models. Look at this projection based on Capgemini research. Roughly 75% of electricity providers struggle to predict data center load, and 80% expect these volatile consumption patterns. This creates phantom load requests. If utilities build infrastructure for data center demand that is later delayed or canceled, they will be left holding massive stranded assets. When power supply is scarce, returns look attractive. But if too much capital floods the sector, or if AI efficiency improves, the cycle can reverse into overcapacity and collapsed project economics. These energy requirements have converted traditional physical electricity infrastructure into a speculative financial option on future digital demand. This forces utility companies to act as the primary risk allocators, underwriting the future success and durability of the entire artificial intelligence industry. We won't know for years whether long-term AI adoption justifies an infrastructure build-out of this scale, or if the most expensive part of artificial intelligence was not the software, but the power grid.